Gold reached a historic milestone in 2025, crossing price levels that were once considered extreme, even by long-term market participants. By the final quarter of the year, spot gold prices surged beyond the $4,500 per ounce mark, setting an all-time record across major global trading hubs, including New York, London, and Asia. This move was not sudden or isolated. It was the result of a long sequence of financial, monetary, and structural forces that gradually reshaped the gold market over the course of the year. At the start of 2025, gold was trading near the upper $2,800 to low $3,000 range. Even at that level, gold was already considered historically expensive compared to the previous decade. However, as the year progressed, price momentum accelerated. Gold's price behavior in 2025 cannot be understood without examining the broader macroeconomic environment. One of the most influential factors was the changing outlook for interest rates in the United States. Throughout the year, financial markets increasingly anticipated a transition away from restrictive monetary policy. Even before any formal rate adjustments occurred, expectations alone were enough to influence asset allocation decisions. When investors believe that interest rates are likely to stabilize or decline in the future, the relative appeal of non-yielding assets such as gold increases. This dynamic played a significant role in driving sustained demand. At the same time, the US dollar experienced periods of weakness against major global currencies. Because gold is priced in dollars, movements in the dollar have a direct impact on gold's valuation. A softer dollar lowers the effective cost of gold for international buyers, encouraging additional demand from outside the United States. During 2025, currency markets reflected growing concerns around fiscal sustainability, debt servicing costs, and long-term purchasing power. These concerns contributed to increased interest in assets that are not directly tied to any single government's balance sheet. Another key factor behind gold's record performance was heightened uncertainty across global markets. Financial markets tend to reprice risk aggressively when geopolitical tensions, trade disruptions, or systemic vulnerabilities emerge. In 2025, multiple regions experienced elevated geopolitical stress, contributing to volatility in equities, energy markets, and sovereign bonds. In such environments, investors often seek assets with a long history of value retention during periods of instability. Gold's reputation as a neutral, globally recognized asset made it a natural destination for capital seeking reduced exposure to political and financial shocks. Institutional investment flows played a particularly important role in shaping gold's price trajectory. Large asset managers, pension funds, and hedge funds increased their exposure to gold through futures contracts, options, and gold-backed exchange-traded products. These instruments allow investors to gain price exposure without handling physical metal, significantly increasing the speed and scale at which capital can enter the market. During 2025, inflows into gold-linked financial products reached levels not seen in years, reinforcing upward price momentum. Central banks also remained active participants in the gold market. Over the past decade, many central banks have gradually increased their gold reserves as part of broader diversification strategies. This trend continued into 2025. For reserve managers, gold serves as an asset that is not directly linked to foreign currency liabilities or political decision-making in other countries. Ongoing central bank purchases reduced available supply in the open market, adding structural support to prices and reinforcing investor confidence. On the supply side, gold production remained relatively constrained. Gold mining is a capital-intensive industry with long development timelines. Bringing new mines into production can take years, and output levels are sensitive to regulatory conditions, energy costs, labor availability, and geopolitical stability in mining regions. In 2025, global mine supply did not increase at a pace sufficient to offset rising investment demand. Recycling and secondary supply provided some relief, but not enough to materially alter the supply-demand balance. The structure of the gold market itself also contributed to price amplification. Gold futures markets allow leveraged exposure, meaning traders can control large positions with relatively small amounts of capital. When market sentiment turns decisively bullish, leveraged positions can accelerate price movements, particularly during periods of low liquidity or heightened volatility. This effect was visible during several key trading sessions in late 2025 when rapid price advances occurred over short time frames. It is also important to recognize the psychological dimension of record-breaking prices. When an asset reaches new all-time highs, it attracts attention from a broader range of market participants. Media coverage increases, technical traders respond to breakout signals, and previously cautious investors reassess their positioning. This does not imply irrational behavior. Rather, it reflects how market participants react to new information embedded in price action. In 2025, gold's move above previous resistance levels altered perceptions of what constituted a normal price range. Gold's performance in 2025 also stood out when compared to other asset classes. Equity markets experienced periods of volatility, with sharp rotations between growth and defensive sectors. Bond markets remained sensitive to changes in yield expectations and fiscal outlooks. In contrast, gold demonstrated relative stability in its upward trajectory, reinforcing its role as a portfolio diversifier. For many investors, gold functioned not as a speculative vehicle, but as a means of balancing risk exposure across uncertain financial conditions. The question embedded in the discussion surrounding gold's record price levels naturally arises from this context. When prices reach unprecedented territory, market participants begin to ask whether even higher levels are possible. However, understanding gold's movement requires separating observation from speculation. The rise to record highs in 2025 was driven by identifiable financial mechanisms, monetary expectations, currency dynamics, institutional flows, central bank behavior, supply constraints, and risk management considerations. These forces explain how prices reached current levels without requiring assumptions about future outcomes. From a financial education perspective, gold's 2025 performance offers valuable insights into how global markets respond to changing conditions. It demonstrates how asset prices reflect collective expectations, not isolated events. It highlights the importance of understanding opportunity cost, liquidity, and macroeconomic signaling. It also underscores how long-established assets can regain prominence when confidence in other systems is questioned. As 2025 comes to a close, gold's record price stands as a data point in financial history, shaped by the interaction of policy, markets, and investor behavior. Whether prices remain elevated, consolidate, or adjust is a matter for future observation rather than assumption. What is clear is that gold's journey to record highs was neither random nor accidental. It was the outcome of a complex, interconnected financial environment that reshaped capital flows across the global system. Part 2 will continue from here, focusing on valuation mechanics, historical comparisons, demand composition, and how professional investors analyze gold at extreme price levels, without forecasts, without assumptions, and grounded purely in financial structure and market logic. As gold moved into record territory in 2025, professional investors increasingly shifted their focus from price momentum to valuation mechanics and structural interpretation. When an asset trades at unprecedented levels, traditional valuation models require careful adjustment. Unlike equities, gold cannot be assessed through earnings growth or discounted cash flows. Its valuation is instead framed through relative pricing, opportunity cost analysis, and its interaction with monetary conditions and risk assets. One of the primary valuation lenses used by institutional investors is gold's relationship to real interest rates. Real rates represent nominal yields adjusted for inflation expectations. When real rates decline, the relative attractiveness of holding cash or bonds diminishes, and gold's lack of yield becomes less of a disadvantage. In 2025, real rates showed signs of stabilization after a period of aggressive tightening, which altered long-term capital allocation strategies. This shift did not require immediate policy action. Expectations alone were enough to influence portfolio construction decisions across large funds. Another critical framework involves gold's correlation with financial stress indicators. Historically, gold tends to perform strongly during periods when confidence in financial systems weakens. In 2025, several indicators reflected elevated systemic sensitivity. Sovereign debt levels remained high, fiscal pressures intensified in major economies, and global trade dynamics continued to evolve unevenly. These factors reinforced gold's function as a balance sheet hedge rather than a speculative instrument. Professional investors also analyzed gold through relative asset comparison. When measured against major equity indices, gold's long-term purchasing power preservation became increasingly evident. While equities can deliver higher returns over extended periods, they are also subject to valuation compression during tightening cycles or earnings slowdowns. Gold, by contrast, does not rely on corporate profitability. In 2025, this distinction became more pronounced as investors reassessed concentration risk in equity markets. Currency diversification played a growing role in gold allocation strategies. For global investors managing multi-currency portfolios, gold offered a neutral reference point. It is not issued by any government, does not carry credit risk, and is globally liquid. As currency volatility increased throughout 2025, gold's role as a cross-border store of value gained renewed attention. This dynamic was particularly relevant for institutions operating across emerging and developed markets simultaneously. Demand composition analysis further explains gold's resilience at high price levels. Jewelry demand, which is traditionally price-sensitive, softened in some regions as prices rose. However, this decline was offset by investment demand and official sector buying. Central banks continued to view gold as a strategic reserve asset rather than a short-term trade. Their purchasing decisions are typically long-term in nature and less sensitive to daily price fluctuations. This created a stable demand base even as prices climbed. The structure of modern gold markets also influenced how prices behaved at elevated levels. The presence of highly liquid derivatives markets allows for efficient price discovery, but can also magnify movements when positioning becomes crowded. In 2025, futures and options data indicated increased participation from managed money accounts. These participants respond to macro signals, volatility trends, and technical thresholds rather than physical supply considerations alone. This layered market structure means gold prices reflect both physical fundamentals and financial positioning simultaneously. Liquidity conditions played an essential role as well. During periods of tightening financial conditions, liquidity can become uneven across asset classes. Gold benefits from its deep, globally interconnected markets. It trades across time zones and exchanges, allowing capital to move in and out efficiently. This liquidity advantage made gold particularly attractive to institutions seeking flexibility without sacrificing scale. Historical context also shaped professional interpretation of gold's record levels. While the nominal price reached new highs in 2025, investors often adjust for inflation and currency debasement when comparing across decades. When viewed through this lens, gold's valuation appeared less extreme than headline numbers suggested. This perspective helped temper concerns about price sustainability and reframe the discussion around structural repricing, rather than speculative excess. Another factor often overlooked in public discussion is gold's role in collateral frameworks. In certain financial systems, gold can be used as collateral in lending and settlement arrangements. As regulatory standards evolve and risk management requirements tighten, high-quality collateral becomes more valuable. Gold's acceptability across jurisdictions enhances its utility beyond simple price appreciation, contributing to underlying demand. The mining sector's response to higher prices also remained measured. While elevated prices improve margins, mining companies face constraints that prevent rapid expansion. Capital discipline, environmental regulations, and long project timelines limit the speed at which supply can respond. In 2025, many producers prioritized balance sheet strength and operational efficiency rather than aggressive output expansion. This cautious approach reinforced supply stability rather than triggering oversupply concerns. Investor behavior at record price levels revealed an important distinction between momentum-driven participation and strategic allocation. Short-term traders focused on volatility and technical signals, while long-term investors emphasized portfolio balance and risk mitigation. This dual participation created depth in the market, reducing the likelihood of abrupt dislocations driven solely by speculative activity. From a financial education standpoint, gold's performance in 2025 illustrates how asset prices evolve through layered decision-making rather than single narratives. Monetary expectations, currency dynamics, institutional flows, and structural supply constraints all interact simultaneously. No single factor explains the move. Instead, the price reflects the aggregate behavior of millions of market participants responding to shared information. As discussions around gold's price naturally intensified, professional analysts emphasized process over outcome. Rather than focusing on where prices might go, they concentrated on why prices reached current levels and what conditions supported those valuations. This approach aligns with disciplined financial analysis, which prioritizes understanding mechanisms over making assumptions. By the end of 2025, gold's record price was widely recognized as a reflection of broader financial realities rather than an anomaly. It highlighted shifting perceptions of risk, value, and stability within the global financial system. For investors and observers alike, gold served as a lens through which larger economic and monetary dynamics could be examined without relying on forecasts or speculation. This perspective underscores the importance of treating gold not as a headline-driven asset, but as a complex financial instrument embedded within global markets. Its 2025 performance offers lasting lessons about capital behavior, risk management, and the evolving structure of modern finance.